Hello everybody, I hope you are doing well and safe and healthy during this crisis. Things are not looking very well, but hopefully they're going to start to look better in the next few days. So we need to keep optimistic about this. So let's go into our discussion for this video, in which we are going to talk about the Monetarist School. This is video number 4, and we're going to consider the last set of ideas in this school, which is about the link between the money supply and the balance of payments, the link between money supply and exchange rates. We are also going to consider different regimes: flexible exchange rate, fixed exchange rate, and we are going to talk about the amount of money as an endogenous variable. And also, finally, we are going to consider what is called the main characteristics of this school, including the permanent income hypothesis. So in this slide, we are going to talk about the balance of payments and exchange rate determination. And let's start by talking about what is the balance of payments, or what the balance of payments is. So the balance of payments is an account system to record the amount of money that goes into a country and money that leaves the country. So if more money leaves the country than the money that enters the country, we can talk about a balance of payments deficit. Is the opposite. If the opposite is true, more money coming into the country than money that is leaving the country, we are talking about a balance of payments surplus. So why is the balance of payments important? It might be important because in some financial crisis, usually what is happening in the balance of payments is going to reflect what is happening in the economy. We have had like a crisis in countries like Mexico, for example, in 1994, 1995, and the balance of payments, when investors are not confident in the economy, they started to take their money away from an economy, and then we can start to see a balance of payment deficit in a country. So it can be a good indicator of the health of a country's economy. So an increase in credit, or which we can attribute to an increase in the money supply, can lead to a deficit in the balance of payments. So when we talk about credit, we are talking about, let's say, loans that banks are giving to the public. And usually when there is an increase in the money supply, banks are going to give more credit to the public. And that can lead to a deficit in the balance of payments. How so? So this can happen because some of the money that the banks are lending to people, some of this money is going to be used to buy local goods, but some of that money is going to be used to buy foreign goods, imports. So because of that, we might have like money leaving. We can see money leaving the country, and therefore that can result in a deficit in balance of payments. So let's consider two exchange rate regimes. Let's see, for example, the first exchange rate regime, which is fixed exchange rate. So an increase in domestic credit, M, can lead to an increase in imports and a decrease in international reserves. So we can see a decrease in international reserves because in order to import goods from abroad, remember we are talking about a small economy here, let's say El Salvador, or let's say Honduras. So if people want to import goods from the United States, they are going to demand dollars from the central bank, to buy dollars from the central bank. So the international reserves in the central bank are going to go down. But because people are exchanging the local currency for those dollars, the amount of money in the economy is going to go down. It's going to go back to the original level. So we see an increase in the amount of money, but people want to import more, then there is going to be a reduction in the amount of money. So that is why, in this case, we talk about M, the amount of money, as an endogenous variable. And this is going to lead to what we call a balance of payment deficit, because money is going to leave the country in order to get imports. Another case is a decrease in the domestic credit. So if there is a decrease in domestic credit, this can lead to a decrease in imports, and as a consequence, M, the amount of money in the economy, will go back to the original level, and this can lead to a balance of payment surplus. So there is the main point here is that there is a relationship between the amount of money and the balance of payments. But of course, it is not possible for a country to achieve a balance of payments surplus in the long run just by restricting domestic credit. Because for a country to attract capitals from abroad and to have a balance of payment surplus, a country has to do more than just restricting domestic credit. It has to do, let's say, with returns of investment. It can be about institutions, how stable the economy is. So there are more variables which are related to the balance of payments, more than just the domestic credit, restricting the domestic credit. So when we will see inflation happening in this small economy, Honduras, for example, so inflation will happen in Honduras in this case if there is an increase in the amount of money in a large economy, like the US, for example. If there is an increase in the amount of money in the US, some of this money might be used to buy products from Honduras. So US buyers are going to go to Honduras with dollars. They are going to exchange the dollars for the local currency in Honduras. They are going to buy these local products, and there's going to be an increase in the amount of money in Honduras, and that's going to create inflation. So that is one of the ways in which two countries, the inflation in one country might depend on the monetary policy of another country. Not just the monetary policy of their own country, but what other countries are doing as well, especially if these two countries are linked commercially in terms of imports and exports. So under flexible exchange rate, if there is an increase in the amount of money in the economy, then let's say Honduras increases the amount of money, the local currency, that is gonna lead to a depreciation of the nominal exchange rate, because you have more local currency now compared to a relatively small amount of dollars, and then you are going to see the local currency depreciated, and you might see also an increase in local prices. The real exchange might stay the same, but the idea is important because what currencies are going to be depreciated are those currencies in which of countries which have increased amount of money in the economy. They are linked. Okay, so now let's finish this video with the beliefs of the Orthodox Monetarist School. So what are going to be the core beliefs of this school? Remember that this school was important, especially in the 1970s, 80s, early 1980s, and still to some extent people hold these beliefs. So changes in M are the main determinants on money income. So if there is an increase in the money supply, we might see increases in PT, the money value of income. The economy is stable unless disturbed by erratic movements in M. So if there are some kind of random movements in money supply because of the discretion of people at the central bank, that can make the economy unstable. And that's one of the main reasons economies can be unstable. Of course, during the current crisis, we are seeing the economy unstable because of an external factor, which is the coronavirus. And some might think that it is also because of some bad management of monetary policies of the past. But if the coronavirus, of course, is causing this damage in the economy, there are external reasons why economies can be harmed, like the coronavirus. But for the Monetarist School, in, let's say, normal times, random movements in the money supply can affect the economy. Another core idea of the Monetarist School is the Phillips Curve, which is vertical in the long term. So there is no trade-off between inflation and unemployment in the long term. In the short term, there might be a trade-off, but not in the long term. And another idea is that inflation and the balance of payments are essentially a monetary phenomenon. An increase in the money supply can lead to an increase in prices, but also can lead to a deficit in the balance of payments. And vice versa, a reduction in the money supply can lead to a deflation and also a surplus in the balance of payments. Another idea of the Monetarist School is that fine-tuning the economy is difficult because there are lags. So if we want to fine-tune the economy in terms of production, for example, if we want to increase the money supply, there are some lags in terms of like time lags in terms of the effect that the amount of money can have in the economy. It takes time to identify a problem, a crisis, then it takes time to take action, and then it takes time for action, meaning an increase in the money supply can have an effect in the actual economy. These lags are unpredictable, how long they are going to take. So that is why it's difficult to fine-tune the economy with the money supply. And actually can be destabilizing. Sometimes maybe we want to help the economy, but because of these lags and the uncertainty that happens of the effect of this of the amount of money in the economy, we can actually destabilize the economy instead of helping it. Another core aspect of this school is what we call the monetary rule, which is a recommendation by Milton Friedman and saying in order to achieve price stability, we need to increase the money supply at a constant rate to create the least disturbance possible. And the last idea is what we call the permanent income hypothesis. And this hypothesis says that there are two types of income, permanent income and temporary income. So individuals are going to determine their spending based on permanent income, not on temporary income. So if there is some temporary income, for example, because of government spending, people might save it. They might not spend it because it's not considered permanent. So patterns of consumption are going to be determined by the permanent income, not by temporary income. So this is an idea against the Keynesian school and saying that if there is an increase in government spending, maybe not all of that money is going to be spent by individuals because some of that money is considered temporary, not permanent. And as this coronavirus crisis evolves, we are going to see money going into families, taxpayers, and it's going to be interesting to see what people are going to do with that money. Are they going to spend it? Are they going to save it? Are they going to pay debt? And according to the permanent income hypothesis, people are not going to spend all of that money because it's not considered permanent. So maybe they are going to save some of that money in order to be prepared for the future. But if that happens, then the multiplier effect is going to be reduced. Okay, so we are going to stop here and we are going to continue in the next in our next video with a new school of macroeconomics. Thank you.